Hi, I'm Alex Pollak, Chief Investment Officer at Loftus Peak. Welcome to Update Plus, our monthly tour of the big disruptive trends that are driving business and our portfolios. Today, I want to home in on the reason a disruptive company might not make it into the portfolio, which might be for reasons around price, rate of growth, or even competition and market maturity. The first step in our process revolves around identifying the disruptive trend, which may be a new retailing, banking, or even transport model. We then look for companies that fit that disruptive theme. Once we have a short list of companies, it comes down to pricing. We believe that our edge comes from valuing disruption and allocating capital to the disruptive companies as early as possible, and exiting only once growth and risks are factored fully into the share price. As we have discussed in our most recent update, the link for which is in the show notes, if companies exceed their valuations or increase in risk, we lower the weight or cut them entirely from the portfolios we manage. Apple is a good reason. For a number of years after our inception, Apple was one of the largest positions in the investment portfolios we managed, at times holding a 10% weighting. The thesis was that Apple could leverage its ecosystem of hardware in order to sell higher margin software, and that this software would become more valuable with more users. This is the network effect. That is, when the value of the company grows faster than the number of users of the company's products. The high weighting of Apple reflected metrics around the company as a cyclical hardware stock, without the network effect fully considered. This disconnect allowed us to ride the valuation from $500 billion to around $3 trillion, a six-fold increase. However, midway through last year, we exited and removed the company from the portfolios we manage. At $180 per share, we believe that the disruptive tailwind of the company was baked into the price. This is because Apple's ecosystem is physically constrained by the level of demand for the hardware by users all around the globe. So as the world's appetite for Apple's product was sated, the company's ability to leverage its disruptive edge through the network effect was lessened. Yet, the share price of the company did not accurately reflect this increase in risk. Naturally, if Apple's share price premium were to fall sufficiently, we would be happy to re-enter the stock. But at present, we see more prospective alternatives. We believe that strict adherence to the valuation process has enabled us to generate value for our investors. This does not just apply to Apple. Tesla was a small weight in 2016 until an exit in late 2020. Electric vehicles are clearly disruptive, but Tesla was valued as though it would be the only scaled producer in the world, and we believe this to be unrealistic. Nvidia is currently going through similar scrutiny. Nvidia is the world leader in parallel computation, which is a disruptive technology for computation and is fundamental to artificial intelligence. However, the extent to which it will be the main beneficiary of AI for the next decade is hard to guarantee. We have more than halved our weighting in Nvidia relative to some times in the last couple of years. And at today's pricing, we believe that the disruption and the valuation tailwind for other companies aside from Nvidia are more prospective. That is to say, there is more disruptive valuation in companies outside of Nvidia than there is inside of Nvidia. Thanks again for your time this month. I'm Alex Pollak from Loftus Peak. See you again.